What is payment shock? Payment shock is a mortgage industry term that's used to describe when someone's financial obligations has a sudden and significant increase from where it was previously. Typically, it's when renters are going from what they're paying in rent to what they're going to be paying on their mortgage. Payment shock can be a significant underwriting consideration, especially for first-time homebuyers, because a lot of times many would-be homebuyers may be caught off guard by expenses such as HOA fees, maintenance costs, higher utility bills, things like that. A large housing payment increase could affect your ability to make your mortgage payments, so a lender's going to put your application under a little bit more scrutiny if they think there's going to be a payment shock. Typically, that magic number for payment shock is 150%. Let's just say that you're paying $1,500 per month right now, and your new mortgage payment is going to be $2,250 or above. Well, that's 150%. So they're going to look at your application a little closer, and you may have to go through just a little bit more than what someone whose payment was going to be less than 150% higher than the current rent payment. So as part of the approval process, your lender is going to look at your employment and income history, your savings pattern, your credit history of making on-time payments to your credit card companies and cars and other lenders. And lastly, you should expect that they're going to ask for a letter of explanation as to why this much of a payment increase and basically kind of put their fears at ease. But a strong rental history and a proven ability to manage your finances can help give your lender the confidence that they need to approve the loan. So it's not a deal killer by any means, but just make sure you're on top of your rent payments especially. Try to show a pattern of savings and make sure you're making your credit card payments and so on time.